In April 2012, a building rose out of the Atlantic City skyline that nobody there had ever seen the likes of. 710 feet tall, glass-clad, the tallest structure on the entire Jersey Shore. It was called Revel, and it cost $2.4 billion to build. The plan was audacious. Forget the bus tours, forget the buffet crowds that had defined Atlantic City for decades, and build something that could pull Wall Street bankers and hedge fund managers away from Las Vegas. Beyoncé headlined the opening. It was the only casino resort in Atlantic City to ban smoking on principle, a bet on a cleaner, more upscale future. 2 years later, it was dead. Bankrupt, twice over, its doors closed for good on September 2, 2014, 3,000 people out of a job. And here's the number that should genuinely stop you. This $2.4 billion building sold at bankruptcy auction for $82 million, 4 cents on every dollar it cost to build. Somewhere between the ribbon cutting and the auction hammer, 96% of the value simply vanished. So the question worth spending the next 20 minutes on isn't whether luxury hotels can be profitable. Plenty are, spectacularly so. The question is why a building engineered for the wealthiest travelers on Earth can collapse this completely, while another 5-star property 2 states over quietly mints tens of millions of dollars a year for its owner without anyone outside the industry ever noticing. That gap between the version of this business that builds generational wealth and the version that burns 9 figures to the ground is what we're going to take apart today. Let's start with what it actually costs to get into this business, because the number most people picture is wildly wrong in both directions. A 5-star hotel is not a slightly nicer version of a Holiday Inn with marble in the lobby. According to industry-wide construction data, 5-star properties run somewhere between $330 and $550 per square foot to build, compared to under $200 for a budget property. Translate that into a per-room figure, and the average 5-star hotel room in the United States costs roughly $600,000 to construct once you include the land, the structure, the furniture, fixtures, and equipment that go into it. According to HVS's most recent development cost survey, published in 2026, the median cost across all hotel categories sits at $213,000 per room. But true luxury projects blow past that, regularly exceeding $1.6 million per key. In the most constrained major city markets, where land, labor, and imported materials all collide, industry consultants have reported luxury construction costs reaching as high as $2 million per key before a single guest is ever checked in. Run that math on a mid-sized luxury property, something in the range of 250 rooms, and you are looking at a construction bill that can run anywhere from $60 million on the low end to well over $300 million in an expensive gateway city. And that's before land acquisition and financing costs are even added to the total.
Here's the detail that trips up almost everyone who hasn't actually operated one of these properties. Unlike an apartment building where your tenants sign a lease and stay for a year, a hotel effectively has to resell every single room every single night. There is no lease. There is no guaranteed occupant. Every sunset, a 5-star hotel's revenue engine resets completely to zero, and the entire staff has to convince a fresh set of strangers to walk through the door and pay for a room that, once the night passes unsold, is gone forever. That single structural fact is the root of almost everything else we're about to cover, because it means a hotel's income is only ever as reliable as its ability to fill rooms night after night indefinitely. So how reliable is that really? The 2 numbers that matter most in this industry are occupancy and something called RevPAR, revenue per available room, which multiplies your occupancy rate by your average nightly rate to give a single number that captures how efficiently a property is actually converting its rooms into cash. As of early 2026, the entire U.S. hotel industry, across all categories, was running a trailing occupancy of roughly 62%, an average daily rate of about $161, and a RevPAR of around $100. That's the industry average, budget motels and five-star resorts blended together. But here's where the story splits in two, and it's the split that explains almost every winner and every loser in this business. According to STR, the industry's primary data tracker, luxury hotels posted RevPAR growth of 5.3% in a year where the economy segment actually declined by 1.8%. Other analysts put the gap even wider, with luxury RevPAR in North America climbing at over 7%, while budget properties sat essentially flat. The global luxury hotel market itself, valued at roughly $113 billion in 2024, is projected to nearly reach $182 billion by 2034, growing at better than 10% a year, a pace that dramatically outstrips the broader hospitality sector. In plain terms, right now, in 2026, money in this industry is concentrating hard at the very top of the market, and it's pulling away from everything below it. That sounds like an obvious argument for building luxury, and it is, if you can survive long enough to benefit from it. But the same concentration of wealth at the top of the market that makes luxury hotels attractive also makes them brutally sensitive to who's actually walking through the door, and that's where things get complicated, because owning the building is only the first of three separate businesses stacked on top of each other inside every branded five-star hotel. The first layer is the real estate itself, the physical building, the land it sits on. The second layer is the operating business, the day-to-day running of housekeeping, food and beverage, the front desk, payroll for what can be several hundred staff at a single luxury property. And the third layer, the one almost nobody outside the industry thinks about, is the brand. When you book a room at a globally recognized luxury hotel name, in the overwhelming majority of cases, the company whose name is on the building does not own the building at all. They manage it, or they simply license their name to it under a contract with the actual owner, who is very often a private real estate investor, a sovereign wealth fund, or a real estate investment trust you've never heard of. This separation is the single most important thing to understand about how money actually flows in this industry, because it means three different parties are all trying to extract value from the same hotel simultaneously, and their incentives don't always point in the same direction. Here's how that arrangement is typically priced. According to data compiled by HVS and confirmed across multiple hotel management agreements filed with the SEC, a management company operating a luxury hotel on behalf of its owner collects what's called a base management fee, generally between 2 and 4% of the hotel's total revenue, with 3% being the most common figure in the industry. That base fee gets paid regardless of whether the hotel actually turns a profit that year, simply for showing up and running the operation. On top of that sits an incentive management fee, which only kicks in once the hotel's profits clear a negotiated threshold tied to the owner's invested capital, and once that threshold is cleared, the operator typically collects somewhere between 10 and 25% of the profit above that line, depending on the specific contract. What that structure means in practice is that the management company gets paid something no matter what happens, while the owner, the person who actually put up the hundreds of millions of dollars in construction costs, only gets meaningfully rewarded if the property performs. The operator's downside is cushioned, the owner's is not. Layer the brand fee on top of that, and the math gets tighter still. If the property carries a globally recognized luxury flag, the owner is typically also paying a separate franchise or brand royalty fee, often in the range of a few percentage points of room revenue, purely for the right to use that name and plug into that brand's global reservation system and loyalty program. The pitch for paying that fee is straightforward. A globally recognized name pulls in guests who would never have found an independent property on their own. And loyalty program members tend to book directly, cutting out the online travel agencies that otherwise take a commission of 15 to 25% off every booking they route. For many owners, that trade is worth it. For others, particularly independent operators trying to build something distinctive, it's a slow, permanent drain that never stops, year after year, regardless of how the property performs.
So with all of that context, let's go back to Revel, because now the numbers actually make sense, and the story becomes a genuine case study in what happens when almost every one of these variables lines up against you at once. The project began in 2007 when Morgan Stanley committed $1.25 billion to fund what was meant to be Atlantic City's first new casino resort in nearly a decade. 9 months after construction broke ground, a plane crash killed 3 of the project's construction executives, a grim early sign that seemed to follow the building for the rest of its short life. Construction dragged on through the 2008 financial crisis, ballooning the project's costs and its debt load at the exact moment credit markets froze and Morgan Stanley's own appetite for the deal evaporated. By the time Revel finally opened in 2012, it was carrying an amount of debt that would have required extraordinary performance just to service, let alone turn a profit, in a market that was already sending unmistakable warning signs. And the market itself was the second half of the problem. Revel was betting on attracting a new class of high-spending, sophisticated traveler to a city whose entire identity for generations had been built around bus tour day trippers and all-you-can-eat buffets. The casino's own smoking ban, meant to signal a more upscale experience, alienated a huge share of the gambling customers who actually kept Atlantic City's other casinos running. In its very first month of operation, Revel's casino floor generated just $13 million in winnings, a number that ranked it near the very bottom of Atlantic City's 12 operating casinos, a position it never meaningfully improved on during its entire 2-year existence. The building was extraordinary. The market underneath it fundamentally did not want what Revel was selling. By September 2014, Revel filed for its second bankruptcy in under 2 years and closed its doors permanently. What happened next is almost as instructive as the collapse itself. Brookfield Asset Management, one of the largest and most sophisticated real estate investors on the planet, initially won an auction for the property with a bid of $110 million, itself already a staggering 95% discount to construction cost. That deal fell apart. A Florida developer named Glenn Straub eventually acquired the property for $82 million in 2015, roughly 4 cents on every dollar Morgan Stanley and its partners had spent building it. Straub struggled for years to reopen it, tangling with state regulators and a separate energy company that owned the building's power plant and was owed tens of millions of dollars of its own. The property finally resold again in 2018 for $200 million to a Colorado developer who reopened it under an entirely new name, severing it completely from the brand and the story that had defined its first catastrophic chapter. Even that resale price, more than double what Straub had paid barely 6 years earlier, still represented well under 10% of what it had cost to build barely 6 years earlier.
What actually killed Revel wasn't one single mistake. It was the compounding of nearly every risk this industry carries arriving at the same time. Too much debt taken on during a boom, locked in right as a financial crisis hit, a luxury product built for a customer base that market research suggested existed, but that in practice never showed up in the numbers needed to service that debt. A location whose entire existing customer base was actively repelled by the very features meant to attract a new one. And a fixed asset, a 700-foot building, unable to pivot once the strategy stopped working, forced instead into a years-long bankruptcy process that destroyed additional value with every month it dragged on. Contrast that against what makes the other side of this industry, the side that quietly builds real wealth, actually work. The properties that generate durable, long-term profit in the 5-star category are rarely the boldest, most architecturally ambitious projects chasing an entirely new customer base. They are, far more often, properties built or acquired in markets with proven, established demand for luxury travel, financed conservatively enough that a bad year or two doesn't trigger a debt covenant crisis, and operated under a brand or independent identity that already has an existing base of loyal, high-spending guests before the first room is even sold. The owners who do well in this business tend to think in decades, not in a single opening weekend. Because a 5-star hotel's construction cost is so enormous that it can take 10 to 15 years of steady, well-run operation simply to earn back what was spent building it before real profit even begins to accumulate. There's also a defensive strategy that mirrors something you see across other capital-intensive industries, diversifying revenue beyond just room rates. The most resilient luxury properties don't rely purely on occupancy and nightly rate. Food and beverage revenue, spa and wellness services, event and conference space, retail concessions, and increasingly, in markets where it's legal, gaming all add income streams that don't rise and fall in perfect lockstep with hotel occupancy. A luxury property with a globally recognized restaurant or a spa that draws local clientele who never book a room has effectively built a second and third business inside the same building, insulating itself against the inevitable slow months that every hotel, however well run, eventually experiences.
None of this erases the risks unique to this industry, and being honest about them matters as much as being excited about the upside. Labor is one of the largest and least controllable cost lines a hotel carries. According to the American Hotel and Lodging Association, hotel wages and total compensation hit record levels in 2025, up over 25% from 2019 figures, even as the industry as a whole remained roughly 200,000 workers short of its pre-pandemic staffing levels, with housekeeping consistently reported as the single hardest role to fill. Insurance costs have more than doubled over the past 5 years, and utility costs have climbed by nearly 30% over that same window. Both fixed costs that a hotel has to absorb, whether its rooms are full or empty that night. And the entire industry remains fundamentally exposed to macroeconomic cycles in a way that few other real estate categories are. In office buildings, tenants are locked into multi-year leases that provide a cushion during a downturn. A hotel's entire customer base can simply decide, collectively and almost overnight, to travel less, and every single room that goes unsold that night is revenue that can never be recovered. So does owning a 5-star hotel actually work as a wealth-building strategy? The honest answer is that it works extraordinarily well for patient capital, conservative financing, and a realistic read of who's actually going to walk through the door. And it can destroy 9 and 10 figures of value with startling speed for anyone who gets even one of those 3 variables badly wrong. The 5-star hotel industry heading into 2026 is, by every major measure, in one of its strongest structural positions in years, with luxury RevPAR growth consistently outpacing every category beneath it, and global luxury travel demand still climbing at double-digit rates. That's a genuinely attractive backdrop for an owner who understands what they're building and why. But the same forces that make luxury hospitality one of the most rewarding real estate categories on earth are exactly what made Revel's collapse so fast and so complete. Enormous fixed construction costs, revenue that has to be re-earned from zero every single night, and a customer base whose loyalty, however well cultivated, can evaporate the moment the story the building was selling stopped matching the story the market actually wanted to hear. The 700-foot tower still stands on the Atlantic City boardwalk today, operating now under a name that has nothing to do with the $2.4 billion it once cost to build, a permanent physical reminder that in this industry, the building rarely lies about how much it cost. What it can't tell you, until it's far too late, is whether anyone was ever actually going to come,